Hello, welcome to Finance 690, Finance 485. Today we will talk about securitization and the credit crisis of 2007. So this is basically talking about the 2007-2008 financial crisis. So it talks about the reasons why, perhaps we had a credit crisis. It also talks about, some of the steps taken by the government to limit these types of financial crisis in the future. So basically here I think we are talking mainly about the mortgage. We are talking about the mortgage-backed securities. So if you look, let's say you took a mortgage maybe 20 years back or 30 years back, typically what you might do is you go to a bank, you apply for a loan, they give, let's say you're approved for the loan for, let's say, $300,000. What happens is that the bank gives you the loan for $300,000. The bank gives you the loan for $300,000, and then basically you buy the house. So after you buy the house actually belongs to the bank, or the loan is secured by the assets, which is the house. Okay. Now what has happened is that in recent times there have been a lot of innovations, financial innovations go on, and basically what has happened is that Wall Street has found a way to put these mortgages together. So for example, they might put 300 mortgages together and then they issue bonds based upon these mortgages. So what you see here is that in recent times, banks do not hold on to the mortgages. Generally, they pass the mortgages on to the financial markets. Okay, so this is what this tells you, the originate and distribute model of banking. So if you look at the right hand side where you have the large banks and the borrowers, that is what used to happen in previous times. That is, if you're a borrower, you go to a bank, you take a loan, and then every month you make a principal and interest payment to the bank. And there the bank holds on to the mortgage. But in recent times, because of the securitization, what they do is that they package the mortgages and they sell it in the bond markets as mortgage-backed securities. And in turn, the banks get paid for the bonds. So the good thing is that by having a securitization, the banks are able to provide more mortgages to homeowners. So the idea was that it increases the money available to finance mortgages. Okay, so that was the rationale for having these mortgage-backed securities. Again, you have another picture of the securitized banking. So you have large banks and small banks, and let's say a small bank is giving loans to the home borrower. After they take the mortgage, they might sell the mortgages to another entity, which could be a larger bank. And in turn, what might happen is that the large bank might go to an investment bank, or they might directly package the mortgages and sell them as asset-backed securities. Okay, or collateralized CDOs stands for collateralized debt obligations. So basically here investors can buy the mortgage-backed securities or buy bonds on the repo market. And basically what's going to happen is that the banks become more of a pass-through entity. They do not hold on to the mortgages, or they might hold on to maybe 5% of the mortgages. The rest, 95%, is sold in the financial markets. Now, what is the bad part? We talked about the good part earlier. So the good part was that banks, by doing this, they are able to have access to more capital. So they can do it very frequently, which means that they will have large amounts of money at their disposal to fund more mortgages. What is the bad part? The bad part is that maybe 20 years back, banks would very carefully examine a creditor, a prospective home buyer, to make sure that they have good credit, they have a good employment, and they can afford to pay the mortgages. But now banks don't have to worry so much about that, simply because they are passing on to the risk to the financial market. So that is the downside of securitized lending. So here we have an example of an asset-backed security. So this is from the textbook. So please make sure that you take a look at this chapter, and especially at this material. You will find some short questions, some problems and so on based on this for the assignments. And this is a reasonably straightforward thing. Okay? So here we have the different asset 1, asset 2, asset 3 up to asset n. So basically here we are talking about putting together a lot of mortgages. So that could be maybe 30 mortgages would be 10 million. So 300 mortgages, let's say for 300,000 each, would be close to $100 million or $90 million. And then what they do is that they issue different types of securities. So here what they do is they take the $100 million bond mortgage, and then they split it up into 3 mortgages. So one is the senior tranche. The principal amount is 80 million, and basically as an investor, if you buy this, you get the LIBOR rate plus 60 basis points. So the LIBOR rate, that is the London Interbank Offer Rate. Okay, so the senior tranche, that is the least risky set of bonds, and that's why the interest rate is not that high. Okay, then you have an intermediate term set of bonds, that is the mezzanine tranche, and the principal is 15 million. The return is LIBOR plus 250 basis points. So here what you find is that there is more risk, because in default the senior tranche gets paid first, and the return they get is higher because of the increased risk. And the last one is you have the equity tranche. So that is pretty much like buying stock. So that they are last in line, and the principal is 5 million. The return is LIBOR plus 2000 basis points. So 100 basis points is 1%. Here you're getting a lot of money, and the reason why you're making a lot of money in terms of a high return is because you're also holding on to something quite risky. Okay, so basically what we find here is that 95 million goes to the senior tranche holders and the mezzanine tranche holders, and the remaining 5 million goes to the equity tranche holders. So basically, whenever there is default, even if 5% of the bonds default, it means that equity gets wiped out. Okay, so what you find is that 95 million goes to the senior tranche holders and the principal tranche holders. So if the assets will pay 95 million, then everybody, both those two claimants get paid first. Suppose, let's say, there is only 90 million outstanding. If there is 90 million outstanding, the principals, the senior tranche gets the 80 million. The remaining 10 million goes to the mezzanine tranche. So what we find here is that if there is 90 million being paid out, 5 million is lost by the mezzanine tranche. So they only get 10 million out of the 15 million they are owed. So basically here we are saying that they lose 33% of their investment, and equity tranche is completely wiped out. Okay? So this tells you that when you look at the way people get paid, it's like a waterfall. So the first people who get paid are the senior tranche holders. So after they get paid, whatever is remaining trickles out to the mezzanine tranche holders, and once they get fully paid, the remaining goes to the equity tranche holders. So here, the equity tranche holders, they are the last in line. The second in line is the mezzanine tranche holders, and the first one is the senior tranche holders. So that is why when you look at the interest they get, the lowest is for the senior tranche holders, because they are taking the least risk. The mezzanine tranche holders take more risk, they get a higher return, and the highest return is for the equity holders, because they are the last in line. So basically here what we have is that this gives you perhaps a more different way to put this together. So we have the assets, which could be the original $100 million in bonds. In mortgages, they are split up into asset-based securities, ABS. So the senior tranche gets 80%. It's the highest rated, that is the AAA. And then the second is the BBB, that is the mezzanine tranche, 15%, and equity tranche is the 5%. So that's a BBB rated bond for the mezzanine tranche, and the equity tranche holders, they are not rated at all. Now what they do now is they again take the BBB bonds, the mezzanine tranche, and split it up into 3 categories. So the senior tranche is the AAA. Now one thing you see here is that the mezzanine tranche itself is a BBB bond. Now how can we make it a AAA bond? So basically there, the first 65% of the cash flows from the mezzanine tranche go to the senior tranche. And one of the ways that Wall Street does is that sometimes they also get an outside party to guarantee the loan, or they do some other ways to increase the credit rating. So a triple B bond issue is being upgraded to a triple A bond. Okay. Now the triple B bond is also, the second class is the mezzanine tranche, that is 25%, and the last one is the equity tranche, which is 10%. So if you look at the numbers in the next slide, we have a table which shows what happens when there is default, even partial default, and so on. Okay, you want to make sure you take a deeper look, go back to the textbook and read this, because the assignment has similar type of questions. Okay, so here, let's say that there is a 10% loss on the subprime portfolios. So if there is a 10% loss on the subprime portfolios, what that means here is that equity gets nothing. And the reason being that they were getting the 5%, last 5%. Since 10% is gone, they get nothing. The senior tranche holders get paid fully. The mezzanine tranche holders get paid 10 million out of the 15 million. So they only get 2/3 of the payment, or they have a loss of 5% of 33%. Okay, now if you look at the mezzanine tranche, again it's split up into senior tranche, which is 65%, a mezzanine tranche, which is 25%, and an equity tranche, which is 10%. Now what happens to these claimants? So because the 10% has been wiped out. Basically what that means here is that for this triple B bond, mezzanine tranche, they only get 5%, okay, and they only get 5%, or here, let's go back, okay, so 80 plus 10, 90, sorry, they lose 5% of the 15% cash flow, so they get paid 66% of what they were owed, okay, they lose 33%. What about the mezzanine tranche? The mezzanine tranche loses 93.3%, and the reason why they lose 93.3% is because of the, if you go back to the slide here, okay, mezzanine tranche, they lose 33%, and equity tranche gets nothing. Let's go back for the ABS CDO, they get the first 65%, hence they get paid fully, that is the 15 times 0.65, which is 9.75% of the overall cash flows. So 10% of the overall cash flow, is remaining. So 9.75 goes to the ABS CDO. And then if you look at the intermediate tranche, that is the mezzanine tranche, they only get 0.25% of the overall cash flows. So we are talking about the first set of bonds, the overall cash flows, while they should have gotten 0.0375. So what is the loss here? The loss is 93.33%. Okay, so like I told you, this is a little bit difficult. You want to go back to the tables, you want to take a look at the steps I wrote down and see how they work out. Okay. Now this talks about the US real estate prices 1987 to 2012. So what we see here is that the S&P Case-Shiller Index, what it does is that it is basically an index of the home prices of the different areas in the US. It looks at the main housing markets. Boston is one of them, New York, LA, and so on. Okay. And what we find here is that from 87 to 2005, there was a sharp increase in the housing market values. So from 87 to 99, it went up by almost 100%. So the prices doubled during the 12 years from 87 to 99. So basically it tells you that from 87 to 99, housing prices on average were going up by 8% every year. Okay. From 99 to 2005, so for the 6 years, what we find is that again the housing price more than doubled. It actually almost tripled. Okay, so that was a pretty sharp increase in the housing values. So from 99 to 2005, 99 it was around 80, okay, and here is more than that. So it's almost 3 times, okay. So 200% the prices increased. And the reason why they increased was because of securitization. And along with securitization, lending standards are relaxed, economy was not bad at all, and so on. So all these contributed to a big increase in the housing values. Now around 2005, 2006, we can see that this market started going down. Okay, and it became January '08, it became 150. So that is the housing market crash of 2007, and that was the primary reason why the economy went into a tailspin. And after that, what we find is that at least till 2011, housing prices have been pretty stable, and in recent times we have seen that there has been a reasonable increase in the value of houses, and the biggest increases have been in places that have been the worst hit by the housing crash. So these are places like Arizona, like Michigan, and so on. Those were the places where the housing prices went down the most, and they have also increased the most. They are nowhere near their 2005 highs, but people who were able to buy the houses around the crash, which was like 2008 and so on, they do have a very reasonable return on their investments. So what we find here is that starting in 2000, mortgage originators in the US relaxed their lending standards and created large number of subprime first mortgages. So as an example, when I was teaching at UMass, okay, I could find that I remember talking to a student. He was a reasonably student, like a B plus student and so on. So basically what he was saying was he was graduating. He was originally from California, and his friends in California were calling him, asking him to join them. And the reason being that at the time they could get jobs as mortgage originators, and they were making a very good killing. So they could make 100,000 or more starting. And the reason was they were in the business of selling mortgages, and these are mainly subprime first mortgages. So this combined with very low interest rates increased the demand for real estate, and prices rose. So it was a booming market, and people were concerned about this, especially if you look at Case Shiller. Shiller himself used to write a lot of articles saying that this is a bubble, this is about to burst. And what happened was, whenever the market slowed down, there were more innovations. So what is one of the innovations? To continue to attract first-time buyers and keep prices increasing, they relaxed the lending standards further. So what were some of the lending standards? One was 100% mortgages. So basically what that means that you could buy a house with no money down. How did they do that? They basically gave you two mortgages. One was for 80% of the house value, and the remaining was like an equity mortgage for 20% of the housing value. So basically you could buy a house with practically no money down, and sometimes you even got paid when you bought a house. They could give you even more than the mortgage. The second was an ARM. What is an ARM? So ARM is basically a floating mortgage. So what that means is that for the first year, for the first 3 years, or for the first 5 years, the mortgage would be constant. And after that, the interest rate you pay would basically change with the LIBOR rate or some other benchmark. Then you have teaser rate. So what is a teaser rate? A teaser rate is something which would be like 1% or 2% interest for the first year. After that, it would start going up. And then you had the ninja loans, you had the liar loans, and you had non-recourse borrowing. So here, basically, some of these were they, as a homeowner, if you want to buy a house, you could get a mortgage without any documentation. And to do that, the only thing you can do was pay them 1/4% more or 1/2% more. So one thing you see here is that people who used to go for this type of loans or these liar loans, the reason why they went for that was because they did not want to disclose their true information. So it could either be their credit history was bad, or they did not have a job, and they did not have high income, and so on. So all these basically led to a lot of abuses. And what also happened was, sometimes to get the mortgages, appraisers also used to work with the mortgage brokers as well as the real estate brokers, and basically give very high evaluations for houses. So sometimes these houses were in really bad condition. Maybe that could be worth 100,000. The valuation was 200,000, And here, the person who bought the mortgage, they basically walked away with close to $100,000 in their pocket plus a house. And here, the primary reason why all this took place was because banks, the mortgage brokers, and other people, they were not taking any risk. The risk was being packaged. The mortgages were packed in financial products, so in bonds, and sold to investors. So the investors really did not know much about what they were getting into. Okay? Now, what happened after this? Banks found it profitable to invest in the AAA rated tranches because the promised return was significantly higher than the cost of funds and capital requirements were low. So as we can see here, banks did not typically hold on to the mortgages. They used to sell it in the financial markets. But they would also invest in the AAA rated tranches because these were highly rated and the promised return was high, LIBOR plus 60 basis points and so on. So that was a good return. In 2007, the bubble burst. Some borrowers could not afford their payments when the teaser rates ended. So here, to qualify the prospective homeowners, they would give them a 1% rate of interest for the first year. So for the first year, if you made an income of $30,000, you could qualify because the mortgage payments were $300 or $500 every month. But after that, when it rose to the LIBOR rate or something like that, the interest rate became very high. The interest that had to be paid also increased, which meant that a lot of people who really could not afford the houses, they were buying houses. And in this case, they basically could not afford to make the payments. And usually, till 2005, 2006, it did not matter because the housing prices were going up. So basically, the same people could sell the houses, get out of there. But when the houses prices started going down, people realized that they had negative equity. So let's say they put down $10,000, they already lost it, and the housing value was below the value of the mortgage. So basically here, what people tried to do was, just like we talked in the finance classes, they had a put option, and they had the right to sell the house back to the bank and walk away. So that was what they did, especially in areas like Florida and Arizona. People started walking away from the houses because the mortgage on the house was higher than the value of the house. So sometimes these were referred to as upside down mortgages. So banks started foreclosing on these houses. So especially in places like Arizona and Florida, houses that were worth $300,000, they went down to $200,000, and some of the time these were looted. And you could buy the houses for $50,000 or $75,000 and so on. So even now, if you go to Detroit, you can buy a house for maybe $20,000 or $30,000. Those are pretty tough areas. It is tough to survive there. So I remember, for example, an MBA student here, he told me he had bought a couple of houses in Detroit for $30,000 and $50,000, something like that, renting it out, making $800, $900 a month. So this looked like a very big deal, a very good deal. I was impressed by what he was doing because he was a graduate from Brown. He was joining here for the MBA, but it seemed too good to be true. And after maybe 5 months or 6 months, when I talked to him, he basically had lost everything. His houses were foreclosed, I believe, and he basically got out of that business. And the reason being that you just cannot remote controlly manage houses, especially in areas like Detroit. Okay. So there was a high flight to quality, and credit spreads increased to very high levels. So what we are saying here is that if you wanted people to invest in these mezzanine bonds or the equity tranches, people realized that there was a lot of risk and the required return or what they were asking for increased very much. And as part of this, banks lost a lot of money on their mortgages and so on, also in their investments. Now, what happened here? What really happened here is that what people did not realize was that the whole thing was built upon the housing market. And if the housing market crashed or collapsed, all these different bonds would go down quickly. It was like a house of cards. And there was a high correlation between these movements of these bonds. So here, AAA and BBB and so on, all of them were very closely moving together because all of them were built upon the housing market. And here, recovery rates are less in stressed market conditions. So what we are saying is that these bonds, they were based upon the mortgages, and they were based upon home values. And here, when the home values plunged, banks could not recover much from the homes. They had to pay too many people to collect, and the houses were in very bad shape. They were already looted and so on, or the people who left, they basically beat up the places so badly because they were really upset. And a tranche with a certain rating cannot be equated with a bond with the same rating. For example, the BBB tranches used to create ABS CDOs were typically about 1% wide and had all or nothing loss distributions. So what we are saying is that the risk of an ABS CDO BB tranche is definitely quite different from a triple B bond. And perhaps what another thing is that the banks were also not very much regulated at the time, or things were lax. And the regulatory capital banks were required to keep for the tranches created from mortgages were less than that for the mortgage themselves. So the capital requirements were not very high. Okay. So basically here, I think we already talked a little bit about this before, but basically it showed some of the problems that we face in the case of securitization, and these are primarily agency cost. And here, mortgage originators, if you look at them, their prime interest was in originating mortgages that could be securitized. And the reason being that for the mortgage originators, they get paid based upon the amount of mortgages they create, which means that they did not really care about the credit of the home buyer. They did not care about the employment of the home buyer and so on. What they were really looking for is, how do I make sure that I can get a mortgage for this guy, because my paycheck will go up as I increase the number of mortgages every month. The second was the appraisers or the home valuers. They were under pressure to provide high valuations so that the loan to value ratios look good. So here what we are saying is that you might have a house worth $200,000. This guy might be applying for a $200,000 loan. So they want to get a little bit higher appraisal for the property. That would be 230 or 250. And here, because if you're an appraiser, you get all the business from the real estate brokers, which meant that when the real estate brokers talk to them, you get a higher appraisal. They would do that. Otherwise, they would lose their business, and they could be, the business would slow down, or they could soon run out of business. So that's the reason why they were able to, work with the real estate brokers and the mortgage brokers to give higher valuations. And if you're a trader, basically you are looking to year-end bonus and not worried about any long-term problems. So basically here what we are saying is that for the trader, again, their money came from how much money they made trading, and sometimes they would work with analysts and so on to create inflated values, and basically did not care about what happened in the long term. They were mainly looking for the next 6 months, the next 3 months, or the next month, so that they could collect their year-end bonus and so on. Now, what happened after this? So clearly, it took quite a bit of time for us to recover from the financial crisis. And one of the things that the lawmakers tried to do was they wanted to make sure that at least we don't have the same crisis being repeated. There is no guarantee that we may not have another financial crisis, but we want to do our best to protect ourselves from a similar situation. And what are the steps they did? The first is banks were required to hold more capital. So, especially when they got into riskier businesses, the capital requirements were increased. Banks required to satisfy liquidity ratios. They want to make sure that they have sufficient cash and liquid assets in the case of a crisis. CCPs for OTC derivatives. Bonuses subject to more scrutiny. So one of the rules is that the government can even recover bonuses that were paid based upon, perhaps false performance or wrong performance. Limits to proprietary trading. So this was mainly for banks. They wanted to put some limits on the proprietary trading. So the next few sections I did take it from some notes from a paper from Harvard University. So this talks about what really happened around the crisis. So what we find is that we had 2 or 3 big crises at the time. One was the fall of Lehman Brothers, and the second was the potential collapse of AIG, that was an insurance company. And what happened is that after the AIG collapse, the US Treasury asked Congress for express authority to invest up to $700 billion in toxic mortgages and other assets. So basically, the government started to invest in this type of mortgages to make sure that their value does not go down even further. Okay, so here, this was referred to as the TARP, or the Troubled Asset Relief Program. We also saw the collapse of the biggest thrift, that was Washington Mutual. And we also saw that the prices of commodities, especially copper and so on, started plunging. Okay? And as part of this, mainly to prevent another collapse, the government came up with some acts. And here, there was the key reforms in the Dodd-Frank Act. So this was by two Senate people in the House of Representatives. One was Barney Frank. And you might have heard about Barney Frank. You know, he's a very good friend to UMass Dartmouth. I think he comes here once a year. We have his papers in the library and so on. So I have met with Barney Frank, talked to him about the financial crisis and so on. And he talked about, some of the most important things that they did. The first is, we talked so far about securitization, credit risk retention. And what we said was, in the case of securitization, banks did not have to take on all the risk. Their risk was passed on to the financial markets in the form of bonds and so on. So what the Dodd-Frank Act did basically was that they said that out of these mortgages, banks have to hold on to a section of the mortgages, or to a part of the mortgages. And basically they had to hold on to all three different types of securities. So we had the senior tranche, we had the mezzanine tranche, and we had the equity tranche. So by holding on to all three categories of the securities, the banks were holding on to a certain amount of risk, which basically meant that they would not be completely interested in passing on the risk. They did not have the opportunity. Okay. Then we had a Financial Stability Oversight Council. So to make sure that, in the event of a crisis, they can step in and do the necessary things. Then we had the swaps push-out rule. We had enhanced regulation of the securities market and the credit rating agencies. So one of the things you see here is that the credit rating agencies were also at fault. So these were the AAA and the Moody's, the S&P and the Moody's. And the reason was that they were giving very high ratings to bonds, which were really risky bonds. So for example, how can we convert a BBB tranche into a series of bonds? One of them was a AAA. And the way they did that was, companies like Goldman Sachs, they used to hire people who were working at the S&P or the Moody's. So the way these bonds were rated was proprietary information. And because these people who were being hired from S&P, they used to get maybe $100,000 or $150,000 a year in salary, companies like Goldman Sachs paid them $1 million or more. And the reason why they were being paid was because they knew the secret behind rating of the bonds. And here, by getting the secret, they were able to create bonds of very high rating, although these bonds were actually risky. Okay, so this was, something that the Dodd-Frank Act wanted to control, this type of behavior. Okay. Now, as far as we are concerned, we just want to talk about a couple of these. One is the swaps push-out rule. So the swaps push-out rule will require U.S. deposit institutions and the U.S. branches and agencies of non-U.S. banks to push dealing in certain swaps out of these bank units and into separately capitalized affiliates. The range of covered swaps is unclear, but the rule will not apply to insured deposit institutions with respect to hedging or dealing in swaps based on reference assets that a national bank is permitted to own. So basically here, one of the things that we see in the US is that banks are regulated and most of the deposits are insured by the federal government. So basically, let's say you have $10,000 in Citizens Bank or in Bank of America. Even if these banks have any problems, it doesn't affect you, because your $10,000 is guaranteed by the US government and they will give you back the $10,000. So I believe up to $250,000 of deposits are insured by the federal government. So the benefit here is for banks is that they can afford to take more risk because they know that they will be protected by the US government. So some type of risk they used to do was get into areas like swaps and so on. Now the swaps push out rule, basically what it said was, if you are a big dealer in swaps, you have to separate that business from your primary business. The government does not want to insure you or to guarantee any losses you might have on your swaps and to pay the other people any payments that is due from that unit. So by separating these units, the government basically was trying to ensure that they did not have to guarantee riskier businesses that banks got into. The second is derivatives, which is what we talk about mostly. And here, the most significant aspects of the derivative sections are mandatory clearing through regulated central clearing organizations and mandatory trading through either regulated exchanges or swap execution facilities. In each case, subject to certain key exceptions, new categories of regulated market participants, including swap dealers and major swap participation, and the push out from banks into bank affiliates. So basically here, they wanted to make sure that, as we know, derivatives are a very risky business. And the government did not want the banks to get too much into that type of business, or if they got into that type of business, they want to separate this from the principal activities that banks are supposed to do. So that is why they want to make sure that it becomes more transparent and that clearinghouse are through regulated central clearing organizations and trading takes place only in regulated exchanges or swap execution facilities. So all this would lead to transparency. They would also ask for more, like security and so on when banks get into this type of business. So Congress adopted the view that securitization abuses were a major contributor to the financial crisis. In an attempt to better align market participant incentives, the Act creates a framework for a scheme whereby securitizers will be required to retain a portion of the credit risk with regard to the ABS they sell. So basically here, this goes back to what we said before. So the securitization was in a way good because it helped banks provide more mortgages. So that is the good part. But the bad part was there was a lot of abuses. And the main abuses was banks were no longer interested in verifying the true credit of the mortgage appliers, people who apply, or their employment and so on, because they could pass the risk on to the financial markets. So to prevent that abuse, basically what Congress did was they wanted to make sure that banks that originated these bonds, they were also asked to hold on to a certain amount of this. So that is what we see in red. We'll be required to retain a portion of the credit risk with regard to the ABS they sell. Because they are holding on to the risk, they will do their due diligence. And that was what we see here. That was the primary reason the government had to make these changes. Okay, so I think this is a very important chapter in the sense that it's mainly descriptive. It talks about the most recent financial crisis. It talks about the reasons why we got into those crises, and it also talks about the changes that the government had to make to prevent another such crisis in the future. Okay, take care.